Many of you are probably well familiar with the 4% rule, but did you know that there's a new rule in town? Well, here to talk with me about that is Dana Anspaugh. She's the CEO and founder of Sensible Money. Dana, welcome.
Hi, Bob. Glad to be here. And my understanding is you and I have both recently talked with Bill Bengen, the father of the 4% rule.
Yeah.
And so I think we're going to discuss what we both took away from those conversations.
Yeah, it's interesting. If I think back to when he first came up with the 4% rule, which we'll talk about more as not really the 4% rule, but he has a new book out, and we both had the chance to talk to him about his new book and his new revelation around what the new rule is. So, where to begin?
Yeah, his new book, I think the title is Rethinking Safe Withdrawal Rates. And so I read it, and then I was so interested. I wanted to have a conversation with him to make sure I understood what he was saying. And there was some really entertaining insights in it. One of them was that originally the 4% safe withdrawal rule was the 4.15% rule. And he felt like the point oh 0.05 implied too much precision. And so he just called it the 4.1. And then as the media and the industry kind of ran with that, it got rounded down to 4%. And so the reason I found that so interesting is one, he wasn't intending this to be a rule like a ruler with that level of precision.
Yeah.
And two, on various retirement forums and comments on posts that I see, so many people will start with the 4% rule and then they will round down and go, well, I want to be even safer.
Mm.
And so, but it was already rounded down,
Yeah.
so that original 4% rule was already safe enough. And so I found that really interesting. I wasn't aware of the history there. And I think that can help a lot of people understand that even if you were following that basic 4% rule, that was quite safe. And now Bill has said it can be even higher.
Yeah, what's interesting too is like that 4% rule, he called it the safe max, which was like the max of, right? I get the exact terminology, but that would be in some ways the minimum amount you could take, right? You could have taken more and still been safe in those periods. So that was, sort of eye-opening, right? We looked at it as maybe that was the maximum that you could take and be safe, but it was really the minimum.
It was the minimum. And he tells this story in his book of he tested 349 retirees, each retiring one calendar quarter apart over history. And so that safe max, what withdrawal rate worked for all 349, well, it was the worst case one. So it was based on the one person who retired into the worst market timing in history. And then everyone else's safe withdrawal rate became based on that, lowest minimum denominator.
Yeah.
And so I found that very interesting too, right? Most of us, if that's how we've based our retirement plan, it's not the Great Depression right now.
Hmm.
We've never had Great Depression conditions again. And yet people are often basing what they can withdraw as if it was the Great Depression and the worst market history, starting the calendar quarter that they retired. And so again, another reason to realize that that safe withdrawal rate was, you could safely withdraw that amount and likely even more.
Yeah. And it was interesting. The original research was only based on, I think, two asset classes, right? Just stocks and bonds, large cap and whatever bond index that he used at the time.
Intermediate term government bonds is what it was. Large
Yeah.
cap and intermediate, US large cap and intermediate term government bonds, and about 50-50 allocation over about a 30-year time horizon was the
Yeah.
original research.
Yeah. So fast forward, he's fine tuned the portfolio, and now we have a new rule of thumb, right?
Yeah, and his new rules. So he goes into all the details in his book, and he's added asset classes like micro cap, uh, mid cap, international, treasury bills. So it used to be intermediate term government bonds. So he's added all of these asset classes. And today that makes sense. Nobody, well, I shouldn't say nobody, but most people would not use a two asset class portfolio, right? We would have far more diversification. So he updated the research based on all of that and came up with a new minimum of the 4.7% safe max. And that was based on an allocation of 55% stocks, 40% bonds, and 5% in cash over a 30-year time horizon. So again, looking at all the various calendar quarters, it was like, okay, the one person who retired in the worst time in history with this allocation could have withdrawn 4.7%. And since then, he's posted to LinkedIn. He's doing additional research on adding or tweaking that asset mix a little bit, particularly increasing the allocation to equities. And so, based on a 65% allocation to equities, he had a recent post that stated he feels like today, in today's market, 5.5% is a safe withdrawal rate. And of course, he emphasized in my conversation with him that it was not meant to be a rule. Like, that wasn't meant to be set it and forget it. That's what he would feel comfortable taking out today, but he's going to relook at it every single year and reevaluate. It's not just 5.5%, and that's what I'm going to do for life.
Yeah. As you and I have talked about on so many occasions, retirement is not a set it and forget it exercise. So it would only make sense that someone of his ilk would say it's a starting place, not the be all end all place.
Yeah, and he had such a good sense of humor about it, and how, it grew into this thing that he never intended.
Yeah.
He started out, he has an engineering background, and he started out simply with some of his own clients trying to answer questions they had. So they would come to him and say, well, how much can I take out, not run out? And he started looking around the industry and couldn't really find any answers. The answers were all over the place. And so he began doing this historical testing to try to come up with a starting framework. I think about, so many things in research. Research is supposed to be something that we continue doing.
Yeah.
And so one person may start with a paper or a set of research that becomes the foundation that additional people build on. And sometimes what happens is that research becomes, the rule. And, we kind of get our blinders on and forget that it's an ongoing process of updating our technology tools to do this kind of research get better. The quality of the data that we have gets better. We have more time now to look at. There's all kinds of things that can impact and evolve that answer over time.
Yeah. And as I think about like how people sort of maybe glom onto this notion of a 4.7% rule of thumb, but Bengen was also much more studious about like how you get there in terms of his 8-point plan to actually come up with, well, what is your withdrawal scheme, and et cetera, et cetera. Maybe walk through these 8 points that you think go into creating a personal retirement income plan.
Yeah, so he has, and he goes through this in his book. He has 8 points. One is what he calls the withdrawal scheme. Basically, what type of accounts are you going to withdraw from, when, how are you going to structure this? Your planning horizon. So, that would be, for example, if you're 55, you have a longer planning horizon than if you're retiring at 70. And so that should be part of the equation. He made a point to distinguish between taxable and non-taxable accounts, and that his safe withdrawal rate is gross. And so if all your money was in pre-tax accounts, IRAs, 401ks, 403bs, 457 plans, well, you have to factor in taxes. Even if you're using that 5.5% withdrawal rate, not all of that's available to spend. A good chunk of that is going to have to go be set aside for your tax payments. So that is one of his 8 points, leaving a legacy to heirs. And so we find the majority of the clients we work with want to be comfortable in retirement. And if there's something left over, then they would like to leave that onto their heirs. Many want to work with us to help out the next generation now, rather than having them inherit, sometimes millions of dollars 20 or 30 years from now. But there's a trade-off. I might be perfectly comfortable at a 6% withdrawal rate if I was okay leaving almost nothing to heirs. And so that becomes, part of the 8 elements that he describes. The asset allocation you use. He described 4.7% if you have a 55% allocation, but 5.5% now if you have a 65% allocation to equities. Well, people have different risk tolerances, and, one person might say, I'm perfectly comfortable maintaining 65% in equities in retirement. That's where we find a lot of our retired households are. But sometimes we have someone who, really isn't comfortable with that. And so their allocation to equities may be a little bit lower. That will be one of the factors to take into consideration. Then there was portfolio balancing frequency. How often do you rebalance the portfolio? He emphasized a point that I loved hearing about, something called a rising equity glide path,
Yeah.
which basically is a concept where you might have a higher allocation to your bonds, your safe investments early in retirement, and you're spending out of that bucket while the equity portion, if it does what it normally does, that part is rising. And so what happens is, maybe 10 years into retirement, you would have a higher allocation to equities than when you started. And so he said that research proved very valid under his own independent testing. And so that would indicate that you might not follow an annual rebalancing process in the traditional sense. There's alternative ways that may add some value. And then there was two other factors he touched on in his 8 elements. One was what's called the super investor, kind of like this fallacy of someone that can pick the right stock or hit it big in real estate. And, how do you factor that in? And then the other was withdrawal timing. Now, again, that's music to my ears. Withdrawal timing. Are you taking your withdrawals out at the beginning of the year, the end of the year? And then I can't remember if he says this in his book, but I know what withdrawal timing means to me also is, which accounts do I withdraw from in which years? And that ties into the withdrawal scheme and the tax factors. So, that's comprehensive. It's not simple like,
No,
here's
it's
your
not like
safe withdrawal rate.
yeah. And I'm looking through my notes for my conversation with him, and the comment that I quoted him as saying is, a 30-year plan is going to encounter problems just like anything else, and how you deal with them is really important to the success of your withdrawal plan. So it does accommodate this notion of, it's not set it and forget it, and it does require you to think about asset allocation and rebalancing and withdrawal, which accounts you're withdrawing from, et cetera, et cetera. So it's a very thoughtful, for people who just sort of like think, oh, it's a rule of thumb. It's much more thoughtful than that. There's much more that goes into that rule than just blindly accepting it.
Yeah, and you've heard me talk about this. One of my challenges with using it as a rule is, I have seen people use it, very rigidly on an annual basis. And yet I know from looking at a bigger picture, if I look at people's withdrawals projected over their lifetime relative to their assets, something we call a fundedness calculation, that oftentimes larger withdrawals can be supported, just not forever.
Yeah.
But if I'm in the go-go years and I need to buy a new car, or, a new roof needs to be put on the house, or a wedding comes up and I really want to contribute in a bigger way than perhaps my 4% or 5.5% withdrawal rate would allow. Well, many times those things are perfectly okay if I step back and I look at, well, here's how much I'm projected to withdraw over my lifetime relative to my assets. But if I'm only looking at it on an annual and a siloed basis, I think people can be foregoing some of those things that are perfectly safe. And in reality, it would be fine for them to spend on some of those items.
Yeah. One of the questions I recall asking him, Dana, was about sequence of returns risk, and whether the 4.7% rule would still survive a sequence of return risk. And his answer to me was, well, in the research, this is right. We looked at, this is the worst possible thing. So it did experience sequence of returns risk, and 4.7 is the bare minimum that would guarantee. I shouldn't say guarantee, right? That would
Never
last
say
30
that
years.
word, Bob. Never.
Yeah, that would at least last 30 years of retirement. So, for folks who might be listening and thinking, well, what about if I retire and I experience sequence of returns? That's accommodated in his research.
That is absolutely accommodated. And, I think I've gotten that question many times over my own career is, yeah, but what if this happens the year we retire, and we try to reassure people we've already factored that into the stress testing and into what we've set your withdrawals at. Now, I will say on the opposite end, when markets are doing really well, the last few years, this year in particular, has been an example of that. We often get far more requests from people for extras.
Yeah.
Hey, can I do this? Can I do that? And so I do think there's that natural human tendency to, you see your balances go up, or maybe it's the news, you're watching the market returns on the news. And so your natural tendency is to feel a little bit freer, like, okay, I can do this, I can do that. And then when there's a lot of bad news or the balances are low, people tend to not ask for those extras. So we have to factor human behavior into all of this too.
Yeah. Yeah. So the other thing too that he and I talked about a little bit was this notion of, like, in retirement, you might have several ways of creating income in retirement. You might have the systematic withdrawal plan, the 4% or 4.7% rule. You might have the bucket approach. You might have asset liability matching or LDI investing, et cetera. And when people look at the difference between these, the two major ways, right? Say, the bucket approach and SWIPs. Um, some of the research that I've read by Joe Tomlinson, for instance, suggests that, well, there's no advantage to either one. It's really a matter of preference, and you might have to choose one or the other because, as you said earlier, it's picking a methodology and sticking with it, I think.
Yeah, picking a methodology is so important. And I've also read a lot of the research that shows, either there's no difference between the methodology, or some of the difference can be attributed to the fact that with a bucketing or asset liability matching strategy, you are, you know, following a rising equity glide path. So you tend to have a slightly higher allocation to equities. And then the difference, if the results are slightly more positive under that strategy, can be attributed to that. Now, when you're doing research, you have to standardize all your scenarios.
Yeah.
So I would say the factor that perhaps that research is missing is human behavior.
Yeah.
And so we find that using a bucketing or asset liability matching, floor, upside, bond ladder, whatever we want to call it, it goes by a lot of names, but we find that it can help protect people from making bad decisions. And so when they know that there's a certificate of deposit, an agency bond, something maturing, and that's going to cover all my cash flows next year, when the market's down 15, 20%, they're just not as overly concerned
Yeah.
and less likely to make a bad decision in terms of selling something at the bottom. And so it's very difficult to test that because we don't know what humans are going to do in any given situation. So when you run all this research, you have to assume that, people stick with their portfolio, and all things equal, they stuck with their portfolio. So did one outperform the other?
Yeah. I'm also reminded of what Zvi Bodhi has told me in the past, which is you don't necessarily want to put your lifestyle at risk. And for some people, having a systematic withdrawal plan might feel a bit risky, like you are putting your lifestyle at risk should you have to take less than, say, 4% from the portfolio in order to preserve its longevity. And that's sort of contrary to what the research shows, right? The research shows you'll be fine. But on the other hand, human behavior being what it is I have some fear that if the market's down, that my portfolio won't last and my lifestyle is at risk.
And I think that is such an important factor. It's one of the reasons why I really like Wade Pfau's retirement income style awareness questionnaire. Is, you know me, I'm about mutual respect, and there's a lot of different ways to, quote, skin the cat. And
Yeah.
so there's a lot of different approaches that can work in retirement. We are not all the same. There's, what, I think 8 billion people on this planet, over 300 million here in the United
Yeah.
States. To think that there was one perfect strategy for all of us, well, that wouldn't make sense.
Yeah.
And so there are different strategies that can bring greater peace of mind depending on how you're wired, depending on your risk tolerance. And so, to your point, things like using annuities, using more guaranteed income strategy can be very valuable for people if it's giving them that license to spend, that comfort level with saying, okay, this income is coming in, it's not tied to the market returns. I feel comfortable going out and spending it. And that definitely needs to be factored in.
Yeah. I think we've covered a lot of ground, but is there anything we missed?
Let me look through my own notes. I think, no, I don't think there's anything we miss. I know in talking to Bill and in his book, he definitely emphasized it's not science. I mean, research is research, but it's not like the law of gravity. Um, it is an evolving, field. And he really emphasized the importance of having a process, and revisiting everything annually, not this set it and forget it, but, and he felt like we talked about the frequency of how often you revisit your
Mm-hmm.
strategy. And he agreed with me, annually is sufficient. That's what we
Yeah.
like to do. Even if the market's on a big up or a big down and clients want to recalibrate, we're like, well, let's just use year-end values and, test your plan every year consistently based on the same date so that over time, our methodology is consistent and we know how you're doing. And I think that was a really, really important factor, just the importance of regularly planning, but regularly can mean annually. It doesn't have to mean every day I'm opening up my accounts and seeing how they're doing.